Ladies and gentlemen, I need to clarify something that happened yesterday. Because if you missed it, your investment direction this year, next year, and even the next 3 years could be completely off track. You may not realize it yet, but the Federal Reserve is quickly opening a valve that has been closed for 3 years. Once opened, historically, there has never been a result of asset price not rising. Yes, money is starting to flow out again. December 1, 2025, the Federal Reserve officially announced the end of quantitative tightening. This statement doesn't sound like much, right? Many people may still think QT is over. Wasn't that expected? What's there to be exciting about? But on the same day, the Federal Reserve injected a $13.5 billion into the system throughout the overnight repurchase market. This is the second largest single-day liquidity injected since the pandemic. This isn't a gentle pouring of water. It's directly opening of high hydrant and sparing it onto the market. Moreover, the Federal Reserve has already hinted that this is just warm up. You might think they are making a mirror adjustments. No, they are simply re-injecting money onto the system. They call it reserve management. But the market is honest. Anything that drives asset prices up has a real name: printing money. What happened with every round of liquidity glued assets skyrockets? Money becomes scarce. Ordinary people can't keep up, and the rich finish ahead of everyone else. History has almost never been an expectation, has never been exception, and this time will be no exception. I know these are a lot of technical terms in the market that give some people a headache. So let's put it another way. Imagine a scheduled island with only $1 million island dollars. Everyone has enough to live on, and the economy is lukewarm. Then the government says, we need to do construction, we need to provide welfare, we need to stimulate the economy. The problem is they don't have the money, so they go to the central bank to borrow. The central bank says, no problem, it printed for you. Suddenly, the island's currency goes from 1 million to 1.5 million. The result haven't changed. The result haven't changed. The land hasn't changed. The number of fish hasn't changed. But money has increased. What happened when there's more money? It's obviously things are more expensive. And the most outrageous part is that this new money isn't distributed equally among everyone on the island. The money comes in through specific channels. These who receives it first are the contractors, material sellers, landowners, machinery owners, and resource owners. The assets holders, they use the nearly printed island's currency to buy more assets at old prices. Meanwhile, by the time the money reaches ordinary people, prices have already risen around after round. How can ordinary people not be poor? How can asset holders not making money? How can the wealth gap not widen? This isn't an opinion. This is a mechanism. And the United States now replying this island story on a global scale. This is why the poor are getting increasingly burdened, while the rich are getting increasingly relaxed. Not because they are smarter, not because they are positioned in front where the money comes from. Monetary expansion means wealth is tilting towards the asset side. This is reality. Over the past 3 years, the Federal Reserve has been aggressively withdrawing money, reducing its balance sheet from 9 trillion to 6.6 trillion US dollar, withdrawing 2.4 trillion US dollar. The market has held on for 3 years, but now it's finally entering a reserve freeze. Tightening is the brake, and easing is the accelerator. With the brakes released and accelerator pressed, how will the car go? Will it drive slowly, inching forward, or flying? You should have a good idea. Even more outrageous is that Fed officials themselves can't help but give advance warnings. John Williams of the New York Fed said, we will soon need to expand our balance sheet again. And Lord Logan of the Dallas Fed said, if market liquidity contributes to be tight, we will begin buying assets. We translate to preparing to launch a new round of money printing. And the worst is yet to come. Our report predicts that by 2026, the Fed may buy $50 billion in assets per month. This is conservative estimate, and historical experience shows that once the Fed starts buying, the number only increases. Add to that Trump's expanding nomination of a super division Fed chairman to replace Powell, and do you think Dove would do anything? Continue printing money. So the current situation is QT has ended. Capital injection has begun. Expectations for balance sheet expansion are strengthening. The new chairman is the vision, and the political cycle need prosperity. Can you say there won't be massive asset bubble? I certainly don't. Once money rushes out, assets are always the first to be pushed up, not wages. Therefore, stocks, crypto assets, gold, and commodity will rise at first, while cash will only become less valuable during a rate cutting cycle. Many people are looking at the S&P 500 near its historical high and wondering, can it still rise? Isn't it too expensive? Look at the dot-com bubble of 2000. Valuation back then were many times more expensive than they were now. Nvidia's current valuation is similar to Home Depot and Costco. A historical bubble? Not yet. It's more like the real freezing hasn't even begun. The more expensive you think it is, the closer you are to the starting line. This sounds counterintuitive, but that's really how the market works. What you need to do now is not panic, but to get in the right position. Focus on liquidity, not the news. It doesn't matter how the Fed package is. As long as the balance sheet starts to grow, that's a stimulus. And the market only recognizes that. Don't chase the highs, wait for the pullbacks to buy. Even the strongest bull market has 10 to 20% drawdowns. Jumping in the peak isn't investing, it's suicide. You shouldn't buy the most exciting stocks, buy the most technical ones. Diversity you bet across several high probability sectors. You can be very bullish on AI, like Bitcoin or tech stocks, but don't put all your eggs in one basket. When liquidity comes in, many assets will soar. Never use high leverage, you will die. It's that simple. Bull markets are more ruthless against the leverage than bear markets. Don't disbelieve me. You think the risk high, but the higher the risk, the more the Fed will wait out. Everyone is saying the economy is risky, the market is risky, the banking system is risky. Do you know where the problem lies? The greater the risk, the more the Federal Reserve will loosen monetary policy. This is the tight and true operation of the US financial system that hasn't changed in 100 years. They can't allow collapse. They can only allow printing money. After printing money, assets rise. The ordinary people are diluted. This is the script. What you need to do is avoid being diluted and start on the side of assets. This is underlying logic of wealth. The market won't rise or fall based on wealth you understand or not. It will only move into direction of liquidity, and the Federal Reserve has already drawn this direction for you. You only need to ask yourself one question: am I on the side receiving money or on the side being diluted?